So if you strip your trading down like that, and you approach it with, I want this to be very simplistic for me. I want to know when not to trade and when I should be focusing on taking trades. What happens if you have things like you arrived at a bias on the weekly chart and you think it's going to go higher? You clearly see there's a fair value gap on the weekly chart that you could trade up into, and it affords you at least 150 handles before it gets to the low of the fair value gap above market price on the weekly chart. So that means you have a really decent range. What happens if the next trading day has a 8:30 medium impact news driver, and it's all it has, there's no other news after that, and you sit in front of the charts, and at 8 o'clock, everything's setting up. You can see clearly they've left overnight London relative equal highs. And if it opens up in a manner where is a discount gap, the opening range gap will be a discount, and that gap will be like 50 handles or so. Now, there's no way to determine that for sure if you're looking at 8 o'clock, because it's 90 minutes away when the opening bell happens. But it's already giving you the framework that it's there. How I trade the pre-market session is I think that right before the news comes out, I treat that as the opening bell. It's not. Clearly, it's not at 8:30. I mean, we're an hour away from that then. But what I'll do is I'll wait for that manipulation at 8:30. Usually, it'll drop down, take out some kind of short-term swing low, or trade into a very small inefficiency like a fair value gap, or trade into an inversion fair value gap, something that was expected to send prices lower earlier, but now it's become an inversion fair value gap. So it will trade down into that, and then that's the Judas swing at 8:30 delivery. And then I would look for a long, either with that drop down as a Judas at 8:30, or if you're not inclined to do that, then what you would do, where you would expect to see proof of low resistance liquidity run conditions, expect it to do that, but don't engage it yet. Then wait for it to trade up, create a short-term shift in market structure bullishly on a 1-minute chart minimum, and then see it create a small little fair value gap that it trades down into, and then that would be your entry. You don't need it to be a trade that has the stop loss below the lowest low at the Judas. You don't need that, because if you understand the fair value gap, you'll know that it's not required to go all the way back down there if it's a failed trade. If it breaks out the fair value gap, that's enough, because if it's valid, it'll respect the fair value gap plus a little bit below it, because we allow for that in terms of a mohawk. Just coloring outside the lines is normal. And then expect it to start running fast, and then either run the relative equal highs or run close to them, and then at opening bell, what will happen is they'll run those relative equal highs right on the Judas swing, or not the Judas swing, the opening range from 9:30 to 10 o'clock. And that first impulsive run, people will chase that, but you're already positioned, but you're exiting as it goes up into some other higher time frame PD array that's a premium, whether it be a fair value gap or relative equal high or a single high, where it's buy side resting. And then at 10 o'clock, the retracement that would come in for people that are chasing it, they'll be scared. And the only thing that's happening then is just it's pulling back down into a silver bullet long. Then you buy that, and you ride that into 10:30 to 11 o'clock when you anticipate the lunch macro, where it'll retrace against that run, not all the time, but most of the time, and it'll come back down below a short-term low that usually forms after 10 o'clock. Now, does that sound ambiguous? Is that highly lofty, complicated speech? No, it's a very simple thing. It's very, very simple. But that's how you go and you apply it. Now, what happens if you get that drop down at 8:30? That drop down, right before it drops down, if it trades back above that, you can treat it as a bullish breaker. All conditions being equal. So already, we just talked about two different models using the same framework. The golden ladder, that framework, is simply understanding when should you, when you shouldn't. That's either high resistance or low resistance. The economic calendar tells you in a very binary way when it's likely to be high or low in liquidity. High liquidity is an absence of an economic calendar event, medium or high impact. That's the reason why I was teaching that in the private mentorship. The first thing I opened up with is knowing the economic calendar. Why? What's the importance of that? Because they're volatility injections. That's where the market will spool. It starts running ripping away from some level, reaching into another. If there is no economic calendar event, can it create a low resistance liquidity run condition? Absolutely it can, but it's more likely that it won't. So you shouldn't be surprised that if you go into that day expecting it to occur, but then every fair value gap stays filled in, or if there is a fair value gap, it goes into it and spends time inside of it, or all the previous candles, every time a candle closes, the new candle overlaps the majority of that previous candle, you're in high resistance liquidity run conditions. Turn the charts off and go do something else. And I mean that. If you follow that logic, folks, I mean this. I don't care how long you've been trading. If you use that right there as a basis for what you're doing day by day as a trader, if you're a day trader, that will make you more profitable than anything else I have. And I mean that wholeheartedly, God's honest truth, because that will filter out all of the unforeseen days where you go on tilt. I promise you, if you go back and look at all the times that you blew your account, or you went into major drawdown, or you just hurt yourself financially, you did it on a high resistance liquidity run day. Beyond a shadow of doubt, I guarantee you that's where it happened. And that was the epiphany for me when because I journaled everything like a nutcase. Like I was literally in there journaling everything. Back when paper and ink was cheap. I had a lot of that stuff. I had 3-ring binders full of things like that. And when I would go through and look at all of my bad times, the thing that jumped out at me was every day that I lost money, the chart would look fuzzy. That's why I say it that way. Because back then, I didn't have a language. I didn't have anything to describe it with PD arrays and this and high resistance, low resistance. That was the language I had to create to articulate the things that I had in my mind. But watching price on days that are very overlapping, it's the easiest way of saying it, where every individual candle shares majority of the previous candle's range. That's the clearest, easiest terminology I can use to define what high resistance liquidity run conditions look like. Now, it doesn't mean that it won't create fair value gaps on those days, because it can, most likely will. But what happens is, as soon as it forms it, it completely fills it and then stays in it for a little while. It doesn't want to run away from it. So it's high resistance. It's not creating imbalances that afford you a very low risk entry. When it trades into it, then you expect it to just rip out of it, take off, and run in your direction. That's what you're expecting in low resistance liquidity run conditions. But if you start identifying a market that is either producing high resistance liquidity run conditions, or you even suspect that it is, don't put money into it. Tape read it. I promise you this. I guarantee you, folks, I promise you, with everything that has everything that would be something that you would judge me on, I promise you, if you use this in your repertoire, in your trading, it will yield you better results because you're learning when not to do something. And that is the golden ticket in trading, because everybody has an excuse to get into a trade. Everybody has that. There's no short supply of reasons to get into a trade. Everybody's school of thought, everybody's way of trading, every methodology, every indicator, every tool, pattern, whatever it is, we all have reasons to get in. But how many clearly define when you shouldn't? They all, every single one of them, every school of thought, every educator, every mentor I've ever had, and wannabe mentor, has never, not one time, ever clearly defined a time when you should not ever stick your toe in that water. Because if you do, you will be devoured. Or you will go in there, make one simple mistake and lose a little bit of money. You'll lose your mind over that and try to get back that $50 that you lost plus commission. And then now you're down 500. Well, you can't have that. Let's go back in there and get that $500 plus the drawdown and commission costs and fees. Because if you're trading with a real account, you have real things called fees. NFA fees, commissions, in and out. Hello, that's the real world. And that $500 drawdown day becomes a $2,500 drawdown day, or worse. And you look back at the day when it's done, you're like, man, why was I in that day? Look what it's doing. Right. And some of you don't even know that yet, but you have no excuse now today. You have no excuse. because you put the time and effort to sit with me today, and I took you to the woodshed. Go back and look at your losing days. Go back and look at them. 99% of them are going to be high resistance liquidity run days. And if you're a live streamer, you're going to ignore that because you have viewership watching you and you don't want to be boring. You don't want to say, I don't want to trade today because you're listening to Tom, Dick, and Harry in the chat room. They're at work. They have no idea what they're doing. They're watching you because they're clueless. And they're going to have an influence over you. You're the influencer, but you're letting these morons, these idiots, these do-nothings in the chat influence you and hold you to the fire that you should say, you know what? It ain't worth me doing anything today. And I, as someone that's been doing it for a very long time, I know what I'm doing. If someone starts a stream, like I have 5 people that I usually watch the first 20 minutes or so of their live stream. I like to hear what they expect because I'm looking for them to be opposite of what I'm looking for. And then as soon as they give me whatever that garbage is, I mute them. And then I immediately just start looking at their chat window. And I'm reading what their chat's saying. The more emotionally sided they are about one side of the marketplace or defensive about someone else being argumentative about, no, it's going to go here. If someone goes against the influencer that someone is streaming, there's always this not breaker in the pattern. They break against the direction or the underlying premise to what the influencer or live streamer is saying. I'm looking for that person to step forward. And when that person says the opposite is going to happen based on what that person live streaming is, now what that has done, and I've not seen one influencer not be influenced by their chat. They all are. They all are. But it's really critical in the first few minutes after the opening bell. I'm waiting for that sweet spot. Because what happens is, because the live streamers live streaming, the yahoos will say, oh, look at this guy. So-and-so saying it's going to go this direction. And now what that does is it makes the person that's live streaming very, very emotional. They get animated. They start dancing around because they're nervous. Now they're in an argument. They're in an arm wrestling match in front of their viewership. That's why their live stream replays don't have the chat window. But you have to watch it live. And you'll get the purest sentiment reading where smart money versus stupid money. And stupid money is influenced by stupid people. Think about how many people go online that listen to what other people are doing with their money and they want to just copy them like a sheep. They don't know what's going on that makes these people say that it's going to go up or down, but they're thinking, what if they're right? And I'm gonna be on the sidelines. I didn't follow them, but they made money. I'm gonna feel like an idiot. I better just do what they're doing. Because if they're right, I get to make money. And I can clap hand and clap with them and say, yeah, we're awesome. They want to be like us. They hate us because they ain't us. That's all that nonsense. It's funny. It literally is funny. But this is a repeating phenomenon that you can tap into because there's live streamers that are telling you this information and they don't even realize that they're a sentiment indicator, the purest, best indicator there is. But these same individuals won't recognize that they're in market conditions that they should not be trading in, but because they want to make ad revenue on their live stream, because they don't want to look stupid or weak in front of their viewership, they won't say, you know what, I don't see it today. I'm closing the stream down. Done. Let me tell you something. If live streamers start doing that, and they do it correctly based on what this outlined, number one, there's somebody that cares about their own money and they care about the viewership. Because why sit there and waste time talking about something that ain't going to happen? You don't have a low resistance liquidity condition in the marketplace. That means that your probabilities are low that you're going to be profitable. It's going to be low that you're going to be precise about your entries and your exits. It means you're going to be high odds that you're going to get stopped out, high odds that you're going to have deeper retracements, high odds that you're going to have a terrible entry and not even be accurate about entry to profit. So you have everything going against you, and then you add to it that you're going to do this all in front of other people. What is that communicating? Well, for people that are just brand new, they don't notice it because they just want to be part of the circus. They just want to have part of all this carnival-like atmosphere that they're here. Yeah, let's talk about this guy. Let's talk about ICT. Play that song again. Do this, do that. Remember that time ICT said this? And what about that guy over here? He live streams. He just lost everything. Oh, what about this guy over here? They're all doing that chatter. And they don't even realize that people like me are using them as an indicator, and I'm taking trades based on their stupidity. And then I come back with a dose and say, check this out. And it's completely opposite to everything they're saying. Or I'm sitting still. I'm not taking a trade when they're getting chewed up and they're crying. Oh, I wish I would have. It's how it is sometimes, guys. Every day you can be a winner, blah, blah, blah. My superpower is knowing when not to do something. And it's something that you can learn how to do. And guess what that does? It frees up your responsibility as a live streamer. Go do something else. If your viewership is there to learn how to emulate a good, profitable trader, they'll recognize you avoiding bad days. Why would you not want to have that skill set? Show me, argue with me in the comments, argue with me why that's not a viable skill set that anybody wouldn't want to have. More so if you're an influencer and you're live streaming. Wouldn't you feel more responsible as an educator, influencer, someone that's profiting off of people's watching, being able to showcase your ability to be responsible and show self-control over yourself and say, you know what? I can recognize today that my edge is not available to me. Now, to Tom, Dick, and Harry in the viewership, or on social media, they see that as weakness. Oh, you're not a good trader. You're not a good trader. Because later on in the day, someone's going to say, look what I did. And they're going to say, well, that guy or that gal made this much money and you closed your stream down. You suck. You're not a good trader. And these are the same people that are working jobs that don't know how to trade. And they're giving you a myopic perspective. And if I ever receive comments like that, I laugh that off because I know that was luck. That stuff exists. And you're seeing it happen on a day-by-day basis when people, in the opening bell, in the first few minutes, they're chasing price. They're literally trading in the Judas swing. And many times they're flip-flopping. They don't even know what they're doing. They're just reacting to whatever price is doing. That means you have no idea what you're doing. And you stay in the stream, even when the market's indicating that it's in high resistance. That tells me, and that's why I'm very critical of certain live streamers because they aren't listening. And I don't care if you learn from this and never give me credit for it. I just want to see you get better. Everybody, I just want to see you all do better. But these are very generic traits to the marketplace. And because the markets are algorithmic now, it's very easy to determine when this is where it exists in price. And when it doesn't exist, when it's high resistance, it's hard to trade. When it's low resistance, it's easy. And it's also the same time, so when retail trading works really good. You want to know when bull flags work really good? Low resistance liquidity run conditions. Trade them in a high resistance, and you're going to get chopped up, rode over, and just over, it's done. Might as well just get the reset credit card out because you're going to have to pay for it. But you'll never hear a retail teacher using those things teach you that because they don't know what that means. They don't know what that means. They'll see everything as a bull flag and a bear flag or a pennant, a triangle, a polygram, whatever. It's just an excuse. This is why I'm doing something. I've been watching price long enough and I feel impulsive and this looks like some kind of geometric shape and I have to geometrically get involved. It's silly. It's literally silly. Instead of simply saying, okay, do I have an advantage today? Because if I don't have an advantage, why am I wasting my time and money? I'm not going to waste your time. Everything I teach you, everything I teach and talk about is meant for you to watch and learn so that way you don't have to waste your time and money doing it ever again. But there has to be an investment. You have to make an investment. And with me, it's time. And the folks that spend the time with me, and they're really diligent about taking notes and learning and then going back and saying, let me see if what he said is really going on. All you have to do is take that mindset and apply it. And you'll keep coming back to me. And I don't have to incentivize you any more than simply just telling the truth of what the markets do and how they repeat.